Hello, this is Brian Shannon from Alpha Trends Blogspot. It's Friday, the 14th of December, 2007. The market's closed and the S&P 500 finished with a loss of $1.88 or $1.26. And the rally that occurred pre-Fed has completely failed, obviously, at this point. The market is back down below some key levels that we were hoping would hold as support based on that inverted head and shoulders pattern. But hope doesn't pay in the market. You have to listen to price. And price said that the path of least resistance this week has been lower since the Federal Reserve met and cut interest rates. It's had a negative effect on stock prices. And the market is back below this level here that I've been suggesting was the more important level, which was about 147.25. Now, it broke it only slightly here at the end of the day. There's a chance that it could continue back higher above that level, but with a declining 5-day moving average, like I said yesterday, these rallies, like we saw in here yesterday, will typically fail until the market has time to kind of consolidate those gains and turn sideways a little bit. You look at this 30-minute time frame, and when that trend line was broken and we've had these lower highs and lower lows, it signals that there's a bigger problem here in this time frame. Now, we do have just below this level what's also potential support, and potential support doesn't mean a place to buy unless you're willing to take on much more risk than I think is necessary. And I say more risk than I think is necessary because when the path of least resistance on the larger time frame is lower, like it is here with a declining 50-day moving average, the odds are against you to trade against the trend. The odds favor continuation of the larger time frame. So picking a bottom is a very, very difficult game and something that you shouldn't really attempt to do. When the buyers do gain control, though, then it's time to get involved on the long side until we have a breach of support. So it remains a risky environment, a day trader's environment. I still believe there are some plays out there that are holding up well. I've been talking about Capstone on my blog this week, and yesterday I said that you probably want to take some profits. Hopefully you did some of that because, again, even with a great-looking chart like that, there's still risk involved, and you've got to manage risk. That's job number one in the market. So if we look at the daily time frame, where we are is back below that 200-day moving average. Psychologically, from a closing standpoint, that's not something you wanted to see this week. And if you look at the now the 4-day VWAP, and we're looking at a 4-day chart with a VWAP on there because what it's telling us is the average price since the Federal Reserve meeting. The market is below that level, and that level is declining. So stocks are being sold. They are not being bought. The Fed didn't save the day. For the market to get back above maybe this level here, 149.5, then maybe we can look for a little bit of further upside, but still the odds just don't favor it yet. But again, we always have to be aware of any and all possibilities. Looking at the weekly time frame, it's looking pretty ominous to me. It's just this bearish week here, a bearish big red candle with big volume doesn't bode well for the future, and a lot of people, I think, may start giving up on this market, and that's a scary environment because if they pull their bids and then start actually becoming net sellers, then this market could find itself in a lot of trouble quickly. So continue to be very cautious in here. That 147.25 was broken. Next potential level of support again is down at about 146.25 or so. And if that breaks, then we're probably looking down near 143. Let's take a look at the stocks. Semiconductors, I've been saying it's in a downtrend, and perhaps that this could turn into a bounce up near 140. It didn't do that. It wasn't a high probability trade candidate. It broke down earlier this week with the rest of the market. That 420 level has been taken out decisively now, so there's no short-term strength left in this market. Best scenario you could look at in the semiconductors case is that moving averages are crossing, so maybe that means that the market's being accumulated, but typically that's not the case. We want to look at the direction of the 50-day moving average on a daily time frame the way we use the 5-day moving average on a 10 or 30-minute time frame, and that's telling us guilty till proven innocent on the daily time frame for the semiconductors. The IWM Russell 2000, again, this is the scariest market out there. Intraday had posted a chart that said basically warning, very dangerous here, as it was just sitting right here on this edge. So be sure to check that blog intraday, because I put those posts up there, and it was clearly a time of danger as the market broke down and lost 60 cents from there. It was a nice trade if you're a if you're looking at the inverse funds like the TWM, which is the double inverse Russell 2000. But going back to the Russell itself, you can see here in the daily time frame that this week we found resistance at a declining 50-day moving average. You don't want to see that if you're bullish. We've got the 50-day moving average below the 200-day moving average. This market's breaking down. It's busting through all kinds of levels of support, and it just is not painting a bullish picture here. Next potential support area, potential only, is these lows right here, about 74.80 now, and then you put 74 in jeopardy, and of course we've got that larger area looming near the $73 level, and if that $73 breaks, then that puts this whole move on the weekly time frame in jeopardy, and then I think you're looking at eventually move down towards 67 or so. It remains very dangerous. The sellers are in control of the long-term time frame. I say that because we've got a declining 10, 20, 30, and 40-week moving average on the daily time frame. It's below a 50 and a 200-day moving average, which are both declining. The 10 and 20 are both declining. There's nothing bullish looking about this. If you want it to look bullish, look at it upside down or look at the TWM. That's the bullish way to look at the Russell 2000. So this market remains in serious jeopardy of breaking down hard here. And again, these rallies, these short-term rallies, will typically fail while we have a declining 5-day moving average. So keep your eye on that at all the time. But it's looking very ominous on the longer-term picture. The NASDAQ 100, this stock, this market also, found resistance at an important level this past week after the Federal Reserve announced their change to monetary policy. It was that prior level of support which had become resistance, and if you recall as well, it was also the level of this Fibonacci level, 61.8% retracement. We do now have a declining 50-day moving average. That tells us guilty till proven innocent on this time frame. So you got to really pay attention here. This market is sending a lot of signals, and they're generally bearish. They look bullish for a little while, or if you're looking at a 1-minute time frame, you might see something bullish here in the morning, but be quick to take your profits, because here again on the 1-minute time frame, you can see when it broke below this low and the VWAP was declining, sellers came in at the end of the day, at the end of the week, and were able to really push this market lower. There are still good opportunities if you're aggressive. The one that I had mentioned on my blog had a great day today here, and it still looks like it has the potential to continue higher. So continue to just monitor risk, and we've got right now resistance up near 5160. 50.5 is an important level for the Qs as far as support goes. You look at look at all these time this market and the S&P 500. You can start to make a case on these 30-minute time frames that we're tracing out a head and shoulders top. All bearish signs. Be careful.